This week, we are going over analysis paralysis, right? And then a little subtext there, why too much works against us. Let's break into our first slide, right? And that's how to identify overanalysis, right? And so I'm going to go through my bullet points first. And the first one would be unable to describe rules, right? So again, if you're building your strategy, whatnot, that's different. But if you have your strategy and you're not actively making any changes to it, and you're trading it every day, and you're just not getting those returns, right? The back test, it looks great, you're making great returns, but when you go to live trade it, you're just not getting there. For some reason, you're not getting the same return. And that may be because you're unable to actually write down or describe your rules. Now, the second one I have there is chart is too cluttered, right? Again, this is a common one. You've got 4 different, indicators on the bottom. Your chart's covered in drawings. You've got EMAs all around, every single divergent from the VWAP. And then on top of that, you've got every single order block and supply and demand zone marked out. Like, this is too much. It's too much. And you got to remember that for the most part, a lot of these indicators or drawings or whatever you want to classify them, they are in and of itself the same, because what are they doing? They are depicting areas of liquidity or areas where market's going to reject or be supported. And then the last one I have there is looking for broad market assumptions. So whatever your rules are, that's all you should worry about. You shouldn't look at it as, hey, there's not much volume going on in the market, so I'm going to kind of step back a little. Or, oh, there's a lot of news today, so I'm going to try and step away, right? I'm not saying that you should ignore these things, but I am saying don't make things outside of your strategy be huge determiners on whether you take a trade or not. Be aware of them. If you know news is about to hit and your setup gets there, I truthfully believe you should still take that setup, but be a little bit more cautious, right? Make sure you're 100% focused on it. Make sure you're ready for that wick to come down and stop you out, right? Be ready for these things and try to prepare for them. And if it happens a lot, then add it to your strategy, right? Add these things so that you're not having to overanalyze things that aren't in your strategy, but rather they're a part of the way you trade it, but you do them every day. Overanalysis is not the only time, you're not only overanalyzing the markets when you're doing too much or there's too much on your chart. Sometimes it's when you just try to add 1 extra thing or 2 extra things, but you haven't back tested these things. You haven't seen how they relate to the way you trade. You just think, well, it works for other people, so I'm going to add it today and it's going to help me. That's not real. That's not how this works. Okay, guys, it doesn't have to be super out in the open. Sometimes it's just 1 or 2 extra things that you haven't back tested. That is overanalysis. Now, going into steps to simplify, right? The solution. Simplify your strategy by writing down your rules and ignore anything that is not within those confines of the things you've just written down. And then finally, let's go over why we should simplify, right? The first one I have there is ease of use, right? We talk about consistency a lot. And one of the things that people get wrong so often is that they try to overcomplicate their strategy and they make it impossible for them to actually get those consistent results. Because maybe you can go back through and back test something, right? And you can say, wow, this is getting me huge returns every single day. But those huge returns are because you're day trading on the 1-minute chart and you're taking a trade every 10, 15 minutes. Maybe it's, every 30 minutes. But the point is, in those back tests, you're not taking into account how fast the candle's moving. You're not taking into account how many different indicators you have to watch all at once, right? So if you overanalyze what the market's doing and you don't give yourself ample time to react to it accordingly, that is overanalysis. We need to step back and simplify it so it's easy to use. The second is proper data, right? This is pretty much what I was just saying, but it's making sure that when we look at our back tests, right, that we are taking into account things like slippage, things like commission. A good example of ways to do that would be if you're tracking them using the R to R method, right? That you don't put this trade made me 1-to-1 or this trade made me 2-to-1. Maybe you put this trade made me 0.9 or 1.9. So you take 10%, 10% off the top to account for commission and slippage. That way, when you get to the end of it, you can see, wow, how much did that add up? Maybe you need to add more slippage or commission. Maybe you need to take away less, right? it has to be fine-tuned to your strategy. But at the end of the day, if it's too complicated, then you're going to have improper data. And then when you go to live trade it, you're going to be confused why the results are so different and why it seems like everything's just not lining up the way it should. And then lastly, again, long-term consistency. We've already talked about it, but it ties into those first two, ease of use and proper data. Those two are going to be the things that determine whether or not you have long-term profits and long-term consistency. Without worry, right, what I have below there, without worry that our strategy is unprofitable or that we will make a mistake within the rules, that is what allows us to stay consistent.